All right, thanks everyone. I just wanted to make sure that you guys could see me tonight. We have a little bit of a camera issue, so I think we're good there. But thanks again for putting your location in the chat. In case you guys didn't hear that when I first launched in tonight's discussion, if you want to just kind of share with us where you're joining us from, that'd be super helpful because we're going to talk about market data in our local communities. So it'll help me kind of tailor our conversation around that. So let's go ahead and dive in. Again, thank you so much for coming to our Virginia Homebuyer Workshop. We're proud to be in partnership with the University of Virginia alumni and be able to bring this information to all of our communities across the country. We get a chance to teach classes like this, usually once or twice a week in various markets across the United States. And we're passionate about serving our communities in homeownership. So whether you're a first-time buyer, second-time buyer, maybe you're looking to purchase an investment property, our resources will help you kind of on that journey to whatever kind of homeownership situation you're looking for. Tonight's class will be a little bit more tailored towards our first-time buyers, but certainly, those of you that are looking at other purchase opportunities, we can certainly talk through that as well. All right, let's go ahead and dive in and kind of start off our class. And again, in case you missed it when I introduced myself earlier, my name is Jason Maida. I'm with American Pacific Mortgage, so we're a proud partner of the UVA alumni. And that allows us to be able to get connected with you and to be able to kind of just share with you a little bit more about homeownership. And I think, it's really kind of a great time to have these conversations in classes like this, because one is we're getting towards the end of the year, right? So a lot of busyness happens during the holiday season. You're probably not going to start thinking about your finances until February, right? So we're going to get through the holiday season. But I think at the same time, there's a lot of really encouraging things happening in the market, believe it or not, especially from an interest rate perspective. So we're going to spend some time talking a little bit about that this evening. And so speaking of our talking points for this evening, let's take a look at that. So we're going to look at the housing market in just a little bit. And I know we're all kind of all across the United States, so we're going to spend some time looking at different areas, but really the markets look very similar depending on where you're at. We're going to look at interest rate market. We're also going to do a rent versus buying analysis. In fact, that's going to be our first activities for tonight. We'll also look at credit, how that can help you on your journey towards homeownership. And then we'll spend some time looking briefly at student loans, some of the loan programs that are available to you as a new buyer. We'll also look at documentation that you want to start to gather. So if you're thinking about taking those next steps towards homeownership, what type of documentation do I need to put together? And then we'll talk about some first-time buyer assistance programs. Now, we're going to look specifically at the state of Virginia, which I think a majority of us in tonight's class are in Virginia or nearby. But we'll look specifically at the state of Virginia and first-time buyer programs. But there are very similar programs all across the country. So we can talk through those either offline or we can answer those during the chat. And then we'll wrap up tonight's discussion looking at the process of buying a home. So if I'm saying, hey, you know what, I want to see what this looks like for me and I want to kind of build a home buying plan, what are the steps that's going to take me to go from attending a class, getting pre-approved, then hopefully being a homeowner at some point in time. And so whether that's next year or 2 or 3 years from now, at least you'll have a game plan to be able to move forward. And so that's kind of what our talking points will look like for tonight. And so as we get launched in tonight's class, I mean, we got to first think a little bit about home buying. And first of all, it doesn't even make sense for me. So, probably most of you in science class are in kind of discovery right now. You're trying to figure out what my options look like. I hear a lot of things. I'm searching different things, but what does homeownership look like for me? And homeownership is probably going to be one of the biggest purchases you make in your upcoming financial futures, right? There's an opportunity with buying to create stability in your housing payment and, hopefully an affordable level. Even though, the prices are high, interest rates are still remain relatively high. This is an opportunity to create wealth too, because when you think about wealth and homeownership, it's driven by equity in your home. So whatever my home is worth on a market value perspective versus what I owe on it, the delta is going to be the equity I have in the home. And this equity or asset is you have the opportunity to kind of create generational wealth, if you will, by passing that along to the heirs of your estate. And believe it or not, there's still some really good tax benefits that come along with owning a home. So you can still have the benefits through home ownership. So as we go into tonight's class, I want to first talk a little bit about a rent versus buying calculator. And I'm going to kind of switch screens here and screen share a different page with you guys so we can kind of look at a brief budget for home ownership. And, when we think about home ownership, and like I mentioned, it's going to be one of the biggest purchases you make in your upcoming financial futures. but we got to make sure our budget is smart. We want to make sure that this is an affordable opportunity for us, but as a lender supporting you, we want to make sure it's sustainable over a certain period of time. That's something that you can endure when it comes to the expenses of owning a home. Now, all of our material from tonight's class, we're going to be shared back with you tomorrow morning. Okay, so you're going to get everything that I share with you tonight, including all the links to the calculator like I'm going to review with you right now. And this is the rent versus buying calculator. It's on the Freddie Mac website, and Freddie Mac and Fannie Mae originate and support us with about 70% of all originations across the country. So let's kind of dive into this calculator, and I'll kind of walk you through this budget. And it's a really great exercise for our attendees of these classes, just to kind of go into your own personal finances and figure out what can homeownership look like for me. So I'm going to walk you through the example we have on screen. I do know that somebody's situation in San Jose is going to look different than somebody's financing or affordability in ATL or in Charlottesville. I understand that, but this will kind of give you a little bit of a baseline to how the calculator works. This is the monthly rent we propose. We'll say it's $2,000 a month. You have your renter's insurance. We assumed at $15 a month, and then we're going to assume that our rent goes up 5% on an annualized basis. Okay, so that's kind of the data points for renting. And then on the home ownership side, we're going to assume that we're going to buy a $400,000 house. The minimum down payment, which you're going to learn about during our loan program segment, is 3%. And that's for first-time buyers. For those of you that are second-time buyers, it's 5% minimum. If you're thinking about purchasing investment property, which I think somebody put in the chat, it's generally going to be around 15 to 20% down payment. Okay. We have estimated property taxes. Those will vary depending on where we're going to buy in the country. Homeowners insurance to protect our home. We have maintenance costs for our home. And then when we kind of look at the next tab, it's going to be loan information. We're going to plug in, what does our financing look like for our home? So I have a 30-year fixed mortgage here, which generally for most first-time buyers will be the term of the loan we look at. We have our interest rates, which I put at 7.1 today. We're going to talk about interest rates in just a minute. We have our origination charges, and what origination costs are. Those are the costs you're going to have in working with a lender. Now, one of the benefits in our partnership with UVA alum is we get a chance to discount our origination charges. In fact, they're discounted by $750. So that can make that a little bit more affordable for you when it comes to the expenses out of pocket for purchasing a home. And then discount points, we left that at 0. And where discount points come into play is that when you need to maybe bring down the level of your interest rate a little bit because we have to hit a certain payment level, you have the opportunity of making that investment in terms of cash out of pocket that can be used to bring down that interest rate. It's called points, and points are usually the equivalent of 1% of your loan amount. So if I'm going to finance $350,000, 1 point would be basically $3,500, and that would generally bring down your rate about 0.25%. And then we have other settlement services. Those are going to be things like closing costs. So when we think about buying a home, there's going to be the down payment, but there's also going to be closing costs, things like title and escrow, maybe attorney's fees, or fees for the local county that I'm going to purchase in. We generally recommend our buyers to budget about 2 to 3% of their purchase price for those closing costs. And then the last tab is other assumptions. We're going to assume that our home will go up about 4% on an annualized basis with appreciation, that we're going to be in the house for 7 years, and that when we sell the home 7 years from now, we'll have about 10% of our cost, 10% of our selling cost of our home in like the hard costs that will come from my proceeds of my home. And then I have state and federal taxes state and federal tax rate. And then we have the savings rate, which I put at 3%. I do realize it's a little bit higher. So what the budgeting tool comes back is it says, okay, Jason, your payments on your rent are $2,000 a month, right? Now, if you're going to take the leap and go towards home ownership, you're probably looking at a payment of about $3,500 a month. So we know we're going to escalate by about $1,500 a month. The trade-off for that, or our opportunity of buying versus continuing to rent for the next 7 years, is about $43,000. So that's my opportunity of owning my home instead of renting over the next 7 years. Now, a lot can change in the course of the 7 years if I own, right? Because, hopefully over the next 2-3 years, we're going to see interest rates start to decline. And if I'm paying a lower level of interest rate, then that opportunity over this next 7 years will be for probably more savings, right? If I can go from 7% interest rate down to 5.5% interest rate on my financing, I'm probably going to be able to save a little bit of money, which will in turn increase my equity position, but also my savings in my home. Okay, so that's a quick little budget analysis that we always love to kind of share with our clients in our sessions like this. And again, we'll send out all this material to you tomorrow morning, so you'll have this at your disposal. Let's now talk about the housing market, and we're going to look at Virginia, and then we can talk about other markets too as well, since we have kind of a wide range of guests in tonight's class. But you know, when we think about the Virginia housing market, it really looks really similar to what's going on in other parts of the country. So here's our challenge right now. So we don't have a lot of inventory out in the market. So supply is a bit limited, and we still have a relatively, I'd say, medium level of buyer demand. But what's currently happening in today's market, in fact, we've really kind of experienced this over the last week, is that interest rates are starting to dip. And in fact, we may touch below 7% interest rate in 2023, which is a really encouraging sign. That is going to start to drive up buyer demand. And as we drive up buyer demand, I don't know if inventory is going to be there to support that. And so if we think about kind of our economics 101, right, we have limited supply, high demand. What's that going to do? It's probably going to push prices up a little bit more. So as we go into 2024, you know, some of our early projections are for prices to go up about 5% from where they're currently at right now. And if we look at our chart here, we see that the median sales price is about $419,000 across the Virginia housing market. We see a little bit of a trend upward. And the homes are staying on the market almost 30 days. Well, some of that's a little bit seasonal because we're in the winter buying months, but it's interesting. We are starting to see more buyers get into the market because they're realizing some opportunities. I think if we were to push this chart out further out to the spring of 2024, you're probably going to see prices start to go up a little bit more because, you know, it's the kind of the, you know, these different levels of interest rate will change buyer habits, and especially going under 7%. It's going to bring another kind of wave of buyers out in the market. So I think that's important to kind of understand as you're thinking about when the right time is for you to buy, right? I mean, these prices may be too high for you. Interest rates might be too high as well. And I think every buyer wants the perfect storm of low interest rates, low prices, and it's really difficult to achieve that. Real estate will always generally cycle as do interest rates. And so we're kind of experiencing now interest rates have crested. Now they're starting to go down. Home prices still, we're probably not going to see anything decrease because many existing homeowners just don't want to trade out their 2.5% and 3% rate loans to jump into a 7% mortgage today. So speaking of interest rates, here's kind of what we're seeing in interest rates. So this is kind of shows you what we've experienced. October was a rough month for us at interest rates. I'm not going to lie. Right around the third week of October, we saw interest rates hit the 8% level. We had 20-year highs in interest rates, and you know, obviously, we had a lot of fear of like what's next year. But lo and behold, a week later, interest rates then kind of tipped the scales and went back down. And so this is what you can see here. This is a 30-year fixed mortgage. You know, interest rates now are just hovering above they're about 7.1 to 7.25. I do think we're probably going to get underneath that 7% level. So a super encouraging sign. We're hearing reports that the Federal Reserve may decide to cut rates back in 2024, which would lead to even more of a reduction in interest rates. But it remains to be seen kind of what happens. How do we get here from an interest rate perspective? Well, a lot of that is just what the Federal Reserve has done to increase interest rates to combat inflation. So we've gotten here, and I think Federal Reserve has kind of finished off with their increase of interest rates. Now it's a question of what changes need to happen to make sure the economy does not stall. And I think, you know, you're seeing a lot of that reflected in the recent changes with interest rates. So I had a question that came in. Again, I encourage everyone to ask questions as we roll through tonight's content. So the question is, how is it possible in 2024 if the interest rates come down, then more housing inventory comes in the market, which creates more competition among sellers and lesser housing prices? So I think just to clarify, so the thought process we have is interest rates come down, inventory levels don't increase. So just to clarify, we're not seeing the inventory is going to increase because a lot of existing owners will not necessarily want to sell, but will have buyer competition out there, which could push prices up. Now, if we start to see more inventory come to market, then obviously that'll change that approach. a lot of buyers are considering looking at new homes, right? And you'll see plenty of builders out there that will provide lucrative incentives to get buyers to look at their properties. But ultimately, I think we're still going to be a little bit of a stalemate when it comes to what opportunities or options buyers have in the marketplace. Okay, so hopefully I answered your question there. Let's talk about how interest rates come about for a buyer, because not all interest rates are the same for all buyers. I think it's important to understand the characteristics that go into an interest rate. So it first starts with credit eligibility. So the higher my credit score is, the lower my interest rate is going to be. My loan product that I'm going to select, how much I decide to finance, and then the down payment that I'm going to put into my purchase. So if I'm going to put the minimum of 3% down versus putting 20% down, that will change my interest rate offering. We talked a little bit about discount points earlier in our budget exercise. So obviously you have the opportunity to pay additional costs to bring down your interest rate. And then the term of your loan, usually the shorter your term is, the improved your interest rate would be. Now that's more in a normalized market. We have something occurring right now in the economy where there's an inverted yield curve. Short-term rates are intersecting long-term rates. So a 15-year fix versus a 30-year fix is really not going to be much of a difference. Now, as we hopefully normalize at some point, we'll see a little bit of a separation. Generally, a 15-year versus a 30-year mortgage is probably about a 0.75% difference in interest rate. For most of our first-time buyers, it's a little challenging to go to a 15-year term because just the payments really elevate pretty significantly. But as we meet with our clients and do what we call a consultation, it's our job to really kind of figure out which product is the best match for you. And of course, what rate would be along with that. Rates change every minute in the marketplace. Some products will change once a day, like first-time buyer programs, but interest rates can move every minute. You know, just while we're sitting in tonight's class, the interest rates can move if the markets are open. So that's something we'll kind of help navigate you through as we consult with you during your home buying options. All right, so we had a question that came in the chat about PMI. We're going to cover PMI in just a bit. So just hang tight on that question because we have a whole segment just devoted to PMI. And then another question is, are we a lender or a real estate agent? Great question. So we are a lender. So we only handle the financing side of things. So that's what our expertise is. We always encourage clients, which you'll hear from me a little bit later. We would encourage you to partner with a realtor, or we have preferred realtors that we work with. They can represent you as a buyer in your home search, but we're just on the financing side. Okay, let's talk about credit. And so when I think about designing home buying options for our clients, there's usually kind of two challenges, if you will, for home ownership. It could be just I don't have a lot saved right now, and so that's really kind of impeding my opportunity to purchase. Or it could be on the credit side because maybe I have too much student loans, or I'm a little bit overextended, or maybe I've had some past challenges. So what we like to do in our classes is just to give you a little bit more information and resources around credit, help improve or kind of improve upon what you're already doing with your current credit profile. Now, when we look at the credit weighting, so when we look at how different factors are weighting into the credit score, this is what it looks like. And we're going to look at the score calculation here. 15% is going to be how long I've had credit. So the longer my credit file is, the better my credit's going to be. 20% is going to be how much new credit am I trying to access? How many new accounts have I opened up? How many inquiries have I gotten, especially in the most recent 6 to 12 months? And then how much do I owe on my revolving debt versus my credit limits? So that's also known as credit utilization. That's a third of the weighting. And then 35% is going to be how am I been paying my bills? And especially in the most recent 12 to 24 months. So if I've had some past challenges, I'm over a limit, I made a late payment, those will obviously decrease the credit score. If I've had a past late payment, it gets rated in different days of late. So if I'm 30 days late, there's one box for that. If I'm over 30 and now I'm in the 60-day range, there's that segment, and then there's 90+ delinquencies. The more severe your delinquency is, the bigger impact you're going to have on your credit score. Every loan program has a minimum credit score, and you can see that on screen. So for FHA, it's 580. You see the conventional loan, and then for our veterans that have served, it's 620. And we're going to talk a little bit about the VA product in just a bit. Let's dive in a little bit closer to credit utilization. So when we look at credit utilization, it's your credit limits versus your credit balances. So if I have a $10,000 in credit limit on a card and I have a $5,000 balance, I'm at 50% utilization. Now, the rule of thumb is we want to have utilization below 10%. So in essence, I would want my balance below $1,000 on that credit card. Here's a quick tip to help you kind of manage utilization down as much as possible. And of course, you want to try to keep your balances as low as you possibly can. But when you look at your credit card statement, there's two key dates. There's a billing cycle date or a statement date. There's also a due date. Now, the cycle date or statement date is the date at which the credit card issuer sends out your account information to the credit agencies. And there's three agencies, right? There's Equifax, there's TransUnion, and there's Experian. So what I would encourage you to do is, if you're able to pay down that balance before the end of your cycle date, what's going to happen is you're going to have a much more improved balance and lower utilization. So that will, in essence, bring up your credit score. And you know, if you're in the habit of paying on your due date, it's not that you're doing anything wrong. It's just, if you're trying to improve your credit score, paying that balance down before the cycle date is going to just give you a much better credit score. Now, account closure can be a little bit of a thing that we want to watch, because if you close out in a revolving account, what that does, that takes away all the great credit history from your reporting. So we would just encourage you to just watch closing out accounts, or if you did a balance transfer and now you're closing out the old account, that could hurt you in two areas of your credit score: the length of credit, which is 15%, and then your utilization, because now you have less credit limits that are available to you because you closed out that account. So, you know, just be mindful of that. When we look at credit scores, we look at all three credit scores, but we take the middle score of three. So, you know, we have the three agencies, which we talked about. And if we looked at the scores of each, so let's say, for example, I have a 760 score as my top score, 740 is my middle score, and 720 is my lowest score. From a lending perspective, we're going to take the 740 score for qualifying purposes. Okay. Now, if we have a partner that's going to join me in the application, we're going to take the middle score of my partners, the lowest middle score between myself and my partner. So if my partner's middle score is 680, then we would use the 680 score for qualifying purposes. So it's always the lowest middle score between both borrowers. Now, one of the questions I get often is, you know, whether your marital status changes your qualifying, and it doesn't change your qualifying. So whether you're in a domestic partnership, you're married, you're single, as two individuals applying for a loan, does not change eligibility. We still evaluate equally the income, assets, and the credit as part of the qualifying. Okay. Let's take a look at a quick matrix that I think will be helpful for you. And that has to do with like negative items that can be on your report. So if you're concerned about something that's more of a legacy issue on your reporting, this is how long it's actually going to stay on the credit report. Now, generally speaking, in the most recent 12 to 24 months from the event, that's when it's going to most impact you on your credit score. Okay, so if I've had a late payment on a student loan, it was 6 years ago, is it going to be on my report? Yes. Is it going to impact me as much as something that just hit on my report a year ago? No. And so I think it's important to kind of understand, you know, how long they'll be there on your credit report, but really the impact there. Okay. And before we get off of credit, just, you know, I know one of the, I guess, refreshing or encouraging things as I teach classes, you know, there's no secret to what your credit score is, right? We have so much access to resources, whether it's Credit Karma, Experian, TransUnion, we all have different tools that we can use. When we evaluate options from a mortgage perspective, that score is going to look a little bit different, because Credit Karma is going to use a consumer credit card score, whereas we're going to use a mortgage score for qualifying. So just something to keep in mind, that as you're kind of looking at your options, and you decide to take that step towards homeownership, the score might look a little bit different, but nothing to be concerned about. We always start with a soft credit score when it comes to evaluating options. And there's a difference in inquiries. There's a hard inquiry and there's a soft inquiry. A hard inquiry can impact your credit score, but a soft inquiry doesn't. Just gives lenders visibility to your credit rating. Okay. All right. Before we jump into student loans, I'm going to answer a quick question. And I think I just need a little bit more information. If you want to just kind of add on to that question, or Ken, one of my associates, can take that question, that would be great. Okay, let's talk about student loans. And I know that's a reality for many of us, you know, as alumni, or you know, just kind of starting our financial futures right now. So student loans, especially federal student loans, came online with payments in October. So most of us have some type of payment arrangement. And as lenders, we have to take a look at those student loan balances and payments when it comes to qualifying. Now, there's a couple different ways we can look at that. The standard on a conventional loan is to take 1% of the total balance, and that's what we use for the payment. For an FHA loan, it's 0.5% of the balances, and that's what we use for a payment. It is more advantageous for our clients to use like an income-based repayment amount or program, because that hopefully will give us the lower payment. So if we took an example where we had $75,000 in student loan debt and we're on an IVR payment that's $250 per month, that's what we can use for qualifying purposes. Versus if you're not in some type of payment arrangement, then the default, like I said, would be that 1% or the 0.5% for the FHA loan. Now, if you're in a deferment because you're back in school or you're still in forbearance for whatever reason, we still have to count a minimum payment when it comes to student loan qualifying. So that's just kind of something to keep in mind. And as we consult with our clients, we're going to kind of talk through your student loans and make sure you kind of understand how those can hurt or impact, I should say, your qualifying. We'll definitely talk through that. But again, if you're still in forbearance or you have a deferment, we still have to look at some type of minimum payment for qualifying purposes. All right, let's talk a little bit about loan programs. And so in our classes, we like to talk about kind of the core programs. There's several different options you have to choose as a buyer, but we want to kind of look at a few kind of core products to help you on this journey towards homeownership. So here's the 5 core programs. There's a conventional loan, which when we think about conventional loans, those are Fannie Mae, Freddie Mac loans. Like I said earlier, those are about 70% of all originations across the country. Then there's an FHA loan, Federal Housing Administration loan, that is a government insured loan. And let me just jump back to conventional loans. That has a minimum credit score of 620 on a conventional loan. Minimum down payment of 3%. And that's for our first-time buyers. As I said earlier, if you're a second-time buyer, it's a minimum down payment of 5%. For FHA, it is a 3.5% minimum down payment, minimum credit score of 580. So FHA will be a government-insured loan. We're going to do a quick comparison in just a few minutes to answer the question around PMI. We're going to cross-compare conventional loans versus FHA loans. For our veterans on tonight's call that have eligibility for the VA product, a VA loan allows eligible veterans to basically purchase a home with 0% down, which is amazing. A little bit more flexibility in the guidelines to support the veteran, and it only has a minimum credit score of 620. And recently, the VA has kind of allowed us to go up to higher sales price limits and still maintain the 0 down payment option. So for those of you, like I think I have one of our guests that's in San Jose, higher cost of living market versus other markets, you could purchase $1.5 million property and still have a 0 down payment option. Now, for those of us that want to purchase in rural areas, there's a product called USDA. And USDA is the United States Department of Agriculture. They have a product segment that allows you to purchase in rural areas, designated areas, with a 0 down payment option. There's 2 big qualifiers for this product. There's geography, so it has to be in a deemed rural area, and there's also household income limitations. Also a minimum credit score of 624 for the USDA product. And finally, there's the jumbo loan, and that's for our clients that are choosing to purchase at higher income levels, higher sales price levels. And those will generally be beyond the 766 550 conforming limit. Now, just to kind of step back for a second, in fact, these are the new income limits, loan limits that we're providing you today. These are the new conforming loan limits for 2024 from Fannie Mae and Freddie Mac. And so those are officially in play right now, but they are for 2024, but we're lending to those limits now. So anytime you go beyond 766 550, for example, let's say in Charlottesville, right? Then you'll be in a jumbo loan space. And that's where that down payment can elevate to 10 to 15% down. Jumbo loans not only have down payment and closing cost requirements, but they also have reserve requirements, which basically means as a buyer, I need additional assets to cover reserves, which will generally be about 12 months of my equivalent monthly payment. So if I have a $6,000 mortgage payment, times that by 12, I need an additional $72,000 in assets. Doesn't necessarily have to be liquid, but they have to be assets that I have behind. Okay. We're going to go into PMI right now. I had a question that came in the chat about FHA versus conventional. So we can talk a little bit about the benefits of FHA versus conventional in just a second, but let's kind of compare the PMI setup on conventional versus FHA. So when you're kind of doing your home search, maybe some of you already started that, right? You might be using the calculators on Redfin or Zillow or Trulio, whatever you're choosing to use. Those calculators generally are not calibrated to what an actual PMI payment is, especially on a conventional loan. Because when we look at conventional PMI, there's different payment options. First of all, you can pay it monthly. You can take that premium, split it up monthly, or pay some of it up front. You can buy all of it outright. That's called a single premium. You can also increase the cost of your interest rate to buy out your mortgage insurance. So there's a variety of different ways you can facilitate payment of PMI. And by the way, PMI stands for private mortgage insurance. The most common option is to pay for that monthly. And the reason why is because there's cancellation options in conventional mortgage insurance, which says that once I have 2 years in my home and 20 to 22% equity, I can apply to have that mortgage insurance canceled. So where the premiums differ on some of those search sites you might be looking at versus what an actual PMI payment is around the characteristics that go into the premium of PMI. So it takes into consideration your credit score, what your down payment is, and then how much you decide to finance. So if I'm at an 800 credit score, even though I'm putting 3% down and I'm financing, say, 300,000, that PMI might not be as impactful as you might see in your general calculators that you're using. So when we look at, in fact, we have a calculation here at the bottom of screen, you can see what that comparison might look like. So if you bought financing 450,000, you put 3% down, you have a 740 credit score, your PMI is going to be about $183 a month. So not as large as you might see in some searches that you're doing on certain calculators online. So a little bit more reasonable. But again, that will change based upon what your credit score is and ultimately what your down payment is. So if I decide to put 10% down, that premium will get a little bit lower. And of course, if my credit score is higher than 740, that will help as well too. Now, FHA mortgage insurance is going to be a little bit different. And FHA mortgage insurance has a set premium that's at 0.55% of my loan amount. And so I take that 0.55% and I times it by whatever my loan is, divided by 12. That's what I come up with my premium. But FHA mortgage insurance also has another insurance component. It's called upfront mortgage insurance. That adds 1.75% on top of your loan amount. Now, with FHA mortgage insurance, it does not have a cancellation option. So you're going to have to maintain that for 30 years unless you decide to refinance your home in the future and maybe switch to a conventional loan product. So let's look at the PMI option here on FHA. So now we take that same 450 loan amount, right? Our PMI with the 0.55% factor is now 206 a month, but then we have to add in 78.75 on top of my loan balance. So now I'm going to finance $7,800 more into the FHA loan, right? So just a quick glance, you can see obviously FHA is going to be a little bit more expensive than a conventional product, and so that might get kind of raise some red flags, if you will, for us as a buyer. But I think it's important to understand these products serve different purposes from the perspective of not every client can qualify in a conventional loan. We learned that the conventional credit score looks a little bit different than FHA. FHA is going to have a little more leniency, especially if I had some past challenges. Let's say I missed a credit card payment 2 months ago. FHA is probably going to be okay with that. Or let's say I had a bankruptcy that was 3 years ago. FHA totally okay with that because it's a 2-year requirement for seasoning. Whereas a conventional loan, I couldn't qualify in that type of product. So that's why this gives us as lenders and buyers options to help you get the right product that meets your needs. But certainly PMI is something that we're going to kind of talk through as we build financing scenarios for our clients. Okay. So for our attendee that had the question in PMI, hopefully that answers your question, but certainly we can kind of circle back to that if you guys have any kind of follow-up questions. Okay, so as we're preparing for home ownership, we're going to have to put together documentation. It's probably not the most enjoyable thing, but we're going to have to dig out certain things like our W-2s, last 30 days of pay stubs. We're going to get together bank statements, things like that. Now, if we're self-employed, it's going to be a little bit more document intensive because we're going to need the last 2 years of tax returns. And by the way, you do have to be self-employed at least 2 years to qualify for financing, just so we can see kind of a track record of the business. You also need to prepare a profit and loss statement and a balance sheet. And if you're working with a CPA, generally we'll need to review the health of the business through the CPA. So that's kind of what we generally would need. Now, in this part of the class, I also like to talk about different employment scenarios because there's a lot of misconceptions out there, especially about time on the job and qualifying for a mortgage. So the first rule is that we do have to verify at least 2 years of history between both your employment and or your education. So here's one of the examples I give often in class, which is, let's say I graduated from UVA in the spring of 2023. Now I started my job, I'm off and running. I spent 4 years at UVA. I just started an accounting firm. Even though I just started with that firm, I still qualify for the 2-year requirement because I have 4 years of education that supports the career I'm in now, right? So that's an example where you don't have to have 2 years necessarily in your job, because we hear that a lot. There's not a 2-year job requirement. There's not any type of, I have to at least be on my job a certain amount of time. I just have to establish a 2-year work and or educational history. Now, if I'm thinking about switching careers, maybe I'm, working for this accounting firm, or maybe positions, I should say, I'm going to think about going to a different firm, and I want to, look at what I can qualify on my new earnings with the new firm. As long as we have an executed offer letter, we can use that offer letter for qualifying purposes. Okay. Now, when it gets a little bit tricky is when I have dual employment, and we see this sometimes like in the healthcare industry, especially with maybe some of our registered nurses that are working for multiple facilities. That's when that 2-year requirement comes into play, where I have to show that I've been working dual employment for at least 2 years. So if I work for one clinic for 30 hours a week, another clinic for 20 hours a week, I just have to show that I can simultaneously maintain both sources of employment. Okay. In some cases, we have clients that are in a part-time status, or maybe they have a full-time job, but then they also have part-time income. In order to have part-time income included or factored into your qualifying, in that case, we also have to show that you've been on the job for 2 years doing full-time work, but also able to maintain the 2 years of part-time work history. Last thing I want to cover in this part of class is just, if I have a partner that's also working or contributes income to the household, but that partner doesn't plan on being on the financing, well, that income cannot be factored into the qualifying. So any income outside of the application that wants to be added into the equation has to be documented by having that person join the application for financing. All right, any questions on employment or documentation that I can help answer for the group? I know I gave you a lot of content there, but hopefully that kind of dispels some of the myths, if you will, when it comes to like taking the next steps in homeownership. All right. And if we need to backtrack, just let me know. I want to stick with kind of income for a second, and I want to explain to you a calculation that you may have heard about already. It's called debt to income ratio. And what it does is it basically shows qualifying for a buyer in looking at their gross monthly income versus their outgoing expenses. And those outgoing expenses will include the new mortgage payment. So it's based upon a gross monthly figure, especially for our W-2 employees. For a self-employed individual, it's going to go off the net figure, so the bottom line number that we're taking as a business. But let's assume that we're a W-2 wage earner. So we're going to look at gross monthly income versus our monthly expenses. Generally, we don't want that number to be more than 43 to 45% of our pre-tax income. And this is just a measurement for qualifying purposes. It doesn't measure affordability. That's a conversation that we're going to have in our one-on-one consultation, just to kind of figure out, really what's the right sales price and or payment level for us as future buyers. Let me answer a quick question. I'm going to explain this calculation. The question is, okay, so the question was, is it okay not to use like business or ancillary income if you don't want to disclose that on your mortgage application? So it depends. We'll have to kind of talk through that. All income, especially if you're doing a first-time buyer program, has to be disclosed to the lender, because most first-time buyer programs have income limits. Now, if it's a business that you've just recently opened in less than a year and there's not a track record of it, then there would be no reason to put it on the application because it wouldn't be qualifying income. Okay. All right. Great question. Let's talk about the debt to income ratio calculation. So I'll just walk you through like a real-time example. So here's what it looks like. So we have principal and interest on my home. So that's the financing part of it, right? The property taxes on my new house and my homeowner's insurance. And then I'm going to add in the PMI that we just talked about. And then we're going to factor in a homeowners association expense if I'm buying like a condo, townhouse, and some of my single family communities that maybe have some different benefits in the community. So let's assume that's $2,500 a month. And then we have other expenses of $500 a month. If we were to take that, divide that by our gross monthly income, my debt to income ratio is about 35.29%. So that would be a range that we'd say, wow, that's really good. That really, when I speak to homeowners across the country, it's about 33 to 36% is kind of the I feel good zone, so to speak. But you can go higher in debt to income ratio. It just really depends on your tolerance level. But again, to my point earlier when we kicked off tonight's class is we're really passionate about affordability because we want to make sure this is an affordable option for you in homeownership, but also that we want to make sure this is sustainable over a certain period of time. All right, so the last stop in tonight's class when it comes to kind of building a plan for homeownership is our savings or assets for down payment and closing costs. So I just want to explain to you kind of really quickly the documentation for assets. It's really pretty easy, but then we'll talk a little bit about first-time buyer programs and options that can help serve you in homeownership. So it's pretty simple when it comes to the documentation. We'll generally need the last 60 days of statements to verify your assets. Cash deposits can't be used for the home purchase. And any type of abnormal or large deposits have to be documented. If you just got your tax refund and that goes into your account, well, that's a sourceable asset. But if you just got $10,000 in cash from your uncle, that would not be something that could be used unless it was sourced as a gift, which we'll talk about in just a second. Retirement accounts can be used, 401ks, 403bs, IRAs. We'd encourage you to talk to your financial planner or advisor before you dip into those assets. And then gift funds, or where I have a family member that's able to document a transfer of assets to me to help me with my home purchase. Those assets do not require any type of seasoning period. Whereas if I'm using my own assets, it generally will require a 60-day seasoning period. So I can't just put $20,000 in my account and then all of a sudden use that. Those would have to be sourced. But a gift can be used immediately as long as we can source it back to the donor's account. So as I mentioned earlier, there's kind of two challenges to home buying, right? It can be just credit, which we talked about already tonight. And then assets would be just, maybe I'm just not there from a savings perspective. And one of the things that, when we design options for clients is we're going to look at first-time buyer options. And believe it or not, all across the country, so whether you're in San Jose, you're in Atlanta, you're in Vermont, there's options offered through state and local agencies to help first-time home buyers, especially low to moderate income households. So for tonight, I'm just going to kind of spotlight Virginia housing, but I know our audience is kind of all across the country. So I would encourage you, if you want to get connected after tonight's class, we'll talk about some of these agencies that can help you. They're generally called HFAs or housing finance agencies. And so let's kind of dive in and talk about Virginia housing. So there's a couple different options that can help you as a first-time buyer. The first is the Virginia Housing Conventional Loan. It's going to give you different flexible down payment options. So you've heard about the minimum down payment for 3% on a conventional loan and 3.5% for an FHA loan. That all holds true. Where Virginia housing is going to come in, it's going to allow you to get some additional assistance to augment what you're going to have to pay out of pocket. So there's a grant option, which you can get up to 2 to 2.5% of the purchase price. Grant funds, if you're eligible, do not have to be repaid. And those are going to be more designed for our lower income households. And then there's the Virginia Housing Plus Second Mortgage, where you can borrow an additional 3 to 5% of the purchase price. And then you can use that to maybe completely cover your down payment and or maybe get additional funds for your closing costs. That second mortgage is repaid generally when you either sell the home or if you decide to refinance in the future. Most first-time buyer programs where it's a grant option, where a grant meaning you don't have to repay back the funds to the agency that you're borrowing from, those are going to be designed for low income housing households, which generally means that I make less than 80% of the median income. Now, these programs from Virginia Housing are going to be higher than that. But when we think more specifically about grant programs, that will be designed for more 80% and less incomes. So here's kind of the different counties and the corresponding income limits. I know this is specific to Virginia, and I know a lot of you guys are in the Virginia market, but for others in other parts of the country, we can, like I said, get connected, talk more about other first-time buyer programs in different states. Like I know one of our guests is from Atlanta, so Georgia has a specific program to help you with first-time home ownership. The attendee that's out in San Jose, we have Cal HFA in the state of California. So a lot of great options to help support our first-time home buyers. All right, well, let's talk a little bit about the process. So this is, as we, kind of think about tonight's class and, the different resources that are available to you and the concepts and terminology for homeownership, let's see kind of how we put this all together in a process, right? So from leaving tonight's class, we would encourage you to get connected with us for a consultation. A consultation builds the framework of home financing, and then the output is going to be pre-approved. So whether you want to buy in 2024 or 2026, you'll kind of have a roadmap and a game plan to homeownership. And so once we get on that path, here's what this looks like. So we get pre-approved at step one, which is kind of the first milestone in the step. And what a pre-approval means basically is that I'm certified through us as a lender that my financing is all set up. Now the pre-approval is good for 60 days, but don't be concerned because that pre-approval can be recertified at any time. A pre-approval also is only a soft credit check, so you don't have to worry about the impact to your credit score at all. And that pre-approval, as I move through different steps, or not necessarily different steps, but to the next step of home or house hunting can be changed or edited, because you may get pre-approved for $500,000, but you may fall in love with a $450,000 house, and that's great. We love to have our clients buy lower if they can. So if we need to edit your pre-approval, we can do that anytime. But step two is house hunting. And that's where you get connected, hopefully with a realtor that can help show you what's out there in your price range in the market. And, you would really want to do a buyer consultation with the realtor so they have a good idea of really what you have as your goals for homeownership. And like I mentioned, that pre-approval can be edited based upon the home that you find out there that maybe ultimately you decide to make an offer on. So if we were to make an offer on a house, let's say that offer gets accepted, right? Now that offer gets accepted, we're going to move to step three, which is called entering escrow. And when we enter escrow, that means we have a ratified agreement with a seller, and it starts what we generally call is the escrow process. The timing of escrow from acceptance of offer to when I get the keys and get a chance to high five, because I'm excited about my new house, is about 30 days. Now we have elevated timelines. It can be as short as 14 days. Depends on if that works for your situation. But general rule of thumb, it's about 30 days to be able to go from step 3 to step 6 in homeownership. Let me answer this quick question. I'll continue with the process. The question was, what factors contribute the most towards the resale value of a house? And that's kind of a question that has probably a really big answer. There's several different factors I think that contribute to resale value. The biggest one being location, and I think to a certain extent, probably the type of property. I get the question a lot. What's better resale ability, condos or single family homes or townhouses versus single family homes? And it really will vary by location, amenities of the community, the state of the particular market you want to buy in. I would encourage you, when you take that path towards homeownership, connect with the local realtor, because they're going to give you more of kind of what's happening in your market. Because some areas in a certain part of the country, single family homes may sell really well, but maybe condos don't sell as well, right? But maybe if I live in a densely populated area where I'm kind of landlocked, maybe condos or townhouses are pretty good investments, right? So it really will just depend on where you're looking at. Okay, so step 3 is going to be entering escrow. That's when the seller, like I said, has accepted your offer. Now, as a buyer, my action items start. So I have to at least within 2 to 3 days contribute an earnest money deposit. And this level of deposit will vary depending on where you're buying at in the country. Usually it's 1 to 2% of your purchase price. And like I said, that deposit has to be executed on the first 2 to 3 days of your contract. This will also kind of start the lending process. And as soon as we get word that your offer is accepted, we're going to give you a call and say, hey, congratulations. This is exciting, and give you an idea of what next steps look like, and then schedule you for what we call a follow-up consultation to meet up with you and review your financing options and make sure the design is correct. That will also start inspections of your home. We'll get the house appraised to make sure the house is worth what you're buying it for. This slide kind of shows you what an earnest money deposit is. Again, kind of footnote here, that 1 to 2% that we're showing will vary across different parts of the country. If you're in California and maybe in the Bay Area market, it might be 3%. So every market has a different percentage, but I think a general rule of thumb is that deposit's going to be 1 to 2% of your purchase price. Now, in most parts of the country, as part of your real estate contract, there will be a thing called a contingency, which gives a buyer a due diligence or homework period, right? You can get a chance to do your homework on the property. which would generally include getting your inspections done on the house, getting the house appraised to make sure it's worth what you're buying it for, and of course, getting your loan approved. So that will usually be in the first, I would say, 2 to 3 weeks of your contract period. Question about the appraisal process. What is the appraisal process? So the appraisal is where a lender puts an order in with a third-party company called an appraisal management company. That appraisal management company contracts with a local appraiser that will go out and physically inspect the property, make sure the square footage is accurate, pull comparable sales in the area to make sure if you're buying that house for $500,000, like properties to yours support that type of purchase price, right? And that's your report that you get. As a lender, we need that for lending purposes, but also as a buyer, it's kind of giving you validation that you're buying at the right price. Now in lending, we only can lend on the appraised value or purchase price, whichever is less. Now, knock on wood, we don't have a lot of issues with this now, but if you buy your house for $500,000, it appraises for $450,000, there's a delta there of $50,000. So in that case, our lending would have to either come down or the seller would have to agree to maybe a lower price, or you would have to make up the difference. Okay, let me answer this quick question and we'll get back to, because I think we're going a little bit deeper on appraisals, but question is, what is comparable sales paid higher? What if something comparable sales are higher priced than the property you're paying for? Well, if you have higher comparable sales, if the house appraises for more than what you're buying it for, that's okay. That's just instant equity that you're walking into. So that's good. I mean, if you're buying it for 500 and the market's supporting 550, then, thumbs up, then we're doing good. We're buying a house that's it's basically undervalued based on market. Okay. All right. Step 4 is going to be processing and underwriting of the loan. That's a lot of the administrative tasks of the loan, right? We're verifying employment, we're verifying assets. By that time, your rate is probably locked in on your loan because, as we learned earlier, rates change by the minute. So we want to make sure we have that added protection. And then we're going to submit into the underwriting group, which underwriting is basically kind of the credit risk side of the business, where it's just evaluating that your application is going to meet all the criteria for the particular product that you're applying for, right? After that approval is completed, that's going to have us about 3/4 of the way through the process. So as a buyer, you're going to be also probably at the end of your contingency period. Now we have to make a decision. So as long as we've got our inspections back, we feel good about it, appraisal comes in, good deal there, and then we have our loan approval. Then if we still feel comfortable with the property, we can sign off on our contingency. And what that does is that tells the seller that we've done all our homework, we feel good, now we want to move to the final stage of the process. As a lender, before we get to the very final stage, we're going to deliver to you a final closing disclosure. That gives you a 3-day cooling off period before you get to step 6, which is closing the loan. That's the one step in the process is an in-person thing. You're either going to meet with an attorney, depending on the state, or a notary to sign your final loan documents. Everything up to that point can all be done electronic signature, but that's the stage where it has to be done in person. And then after you've done that, then you wire or deliver a cashier's check for the remaining amount of money out of pocket. And then there's one final step in the lending process, and that is to fund your loan, which that's where we wire the financing funds to an escrow or attorney's office. That money will get reconciled, and then documents get recorded with the local county recorder's office, which they'll record a grant deed, which transfers ownership to you, and then a deed of trust, which is the agreement to pay back the loan. And then after that's confirmed, we get a chance to make our favorite call of the day, which is to say, congratulations, you're now a new homeowner. And it's the best part of my day. Got a chance to make a few of those calls today because it's a big deal, right? It doesn't come with a lot of stress and anxiety and frustration maybe. But at the end of the day, we want to create a smooth client experience that helps you reach your goals of homeownership as quick and as efficient as possible. But it's a big celebration at step 6. Quick question. I'm going to kind of go into our what's next here for us. The question is, what if you live out of state from the home you are buying? How do you do the in-person signing part? So a lot of times you'll have notaries or attorneys that can send a mobile person out to you. So that's not an issue, especially with a lot of rules in place with the pandemic. Most signings are done mobile anyway. So whether you're in state or out of state, not a big deal. All right, so kind of as we move forward from tonight's class, if you're thinking more about homeownership as one of your goals for this year coming up or beyond, we'd encourage you to get connected with us. Or maybe you have some questions about like some of the topics we talked about tonight. You can schedule an introductory call, or we can go through a consultation. A consultation is a free option for us. There's not a fee for that service at all. It just allows you to have a home buying plan. And like I said earlier, it could be a 2024 goal. It could be a longer term goal. We meet in different stages of home ownership with all of our communities that we support. So here's all the links for the online application. And then what we do is we schedule a video consultation. You have all that available on this slide. A consultation is about a 30-minute session to kind of map out a home buying plan for you. We'll help you kind of educate you on your credit, what that looks like, down payment options, kind of help design you different sales prices after you have a better understanding of the type of property and where you want to buy. And then, like I said earlier, the output of that session will be to hopefully have you pre-approved and start you on that path towards homeownership. Now, we have some really cool resources. One of them is our mobile app. You can even start the process from mobile, but it also has a great calculator. You can also see the different milestones that you're going to experience as a consumer. So really great tool there. As you know about our partnership, you're attending tonight's class because of our wonderful University of Virginia alumni partnership. And we also pass along the $750 discount. And our classes that we teach throughout the year, and we have a really robust schedule for next year in 2024, are open to the public. So you have friends, family, maybe some coworkers that are kind of have some questions about homeownership, want to get connected with us, they're always welcome to attend one of our free classes. Here's all my contact information. So if you have follow-up questions after tonight, and we're going to do some Q&A in a section in just a second, here's all my contact information. Feel free to message me, or if you want to schedule an appointment, that works for me too. And we'd encourage you to check out what our clients are saying about, especially on some of our Google reviews. We're really proud about our client experience that we have out in our markets that we serve. And we try to put out good content in our social channels, especially on Instagram, things that will help you in your resources for home ownership. So we'd encourage you to check us out on our Instagram as well. So as we wrap up tonight, I want to open it up for Q&A. I appreciate all the awesome questions you gave me tonight. I have a few left in the chat, so I'm going to answer those. And I'll stay as long as we need to. I know we're at the top of the hour, so I want to respect everyone's time. So feel free to drop any questions in the chat, and we'll make sure we handle those before we leave tonight. By the way, we also put our scheduling tool in the chat, so you can click that link. You can schedule one of those introductory calls or an upcoming consultation. All right, so we'll see if we get any questions in the chat. And I know it's not the easiest in this time of year to spend, your hours at night with us learning about homeownership, but hopefully this was something that was of value to each of you. And like I said, it's something that you can help, kind of think more about homeownership whenever that time is right for you. Thanks for the positive feedback in the chat. I appreciate that. You're very welcome. I think we might be good. Okay, awesome. All right. Well, thank you so much for attending tonight's class. It was great being with everyone this evening. Have a wonderful evening or upcoming evening, depending on where you're at in the country. And we look forward to connecting with you soon.